welcome. You're watching the Money Control Show. I'm Sakshi Batra, and this is where we talk about macros, markets, and money. On the show today, we'll continue to discuss about debt funds, and we will talk about what happens when there are defaults. We'll also talk about the Aadhaar Amendment Bill that was passed by the Union Cabinet last week. And we'll get you insights into the stock markets and the cues you need to watch out for in the coming week. Debt mutual funds have been in news due to defaults and delays in payments by corporate firms, and as a result, the NAVs of many debt funds were hit in these past 6 to 8 months. Now, some of you have actually written to us on how debt funds work and to find out what happens when there are defaults. Let's take up some of those questions today with Money Control's personal finance editor, Kayezad Adajania. Thanks a lot, Kayezad, for joining in. Welcome to the show. Now, first things first, how do debt funds work? You know, investors often wonder, why do we always talk about defaults when we mention about debt funds? And are there no defaults in equity funds?
So Sakshi, to answer your question, we have to go back to the very basics of what is an equity fund and what is a debt fund. Now, when you invest in an equity fund, what happens is that your equity mutual fund buys an equity share of a company, or even if you buy equities directly, what we are buying is through equity, we are buying equity shares of a company, which means that we are buying a share of the ownership of the company. Now, these shares are traded on the stock exchange, and the share prices move up and down in the short run depending on the demand and supply, and in the long run the share prices moving down depending on the company's future, the company's profitability, the company's sales growth, how well the company does, basically on the company's performance. Okay, so that is how equity mutual funds make money. Equity mutual funds make money on the long-term management and the performance of the company. But when you talk about a debt fund, what is debt? Debt is essentially is borrowing and lending, right? So when a debt fund buys a debt security in the market, essentially it is lending money to the corporate. Now a corporate borrows money for its short-term and long-term purposes. So what does a corporate do when it wants to borrow money? It goes to lenders. It goes to lenders such as banks or NBFCs or even mutual funds. When mutual funds give money to a corporate, that instrument, that lending instrument is called as a debt script. So how does a debt fund make money? The debt fund make money because when the corporate, pays regular interest on that borrowing, and at the end of the tenure, it pays back the loan to the debt fund. So this is how a debt fund makes money. And of course, this debt script is also listed on a stock exchange in any case if any other buyers out there are interested in borrowing this debt. But essentially, it is an obligation of a company to pay interest and the principal on a timely basis to a debt fund. So which is why debt is nothing but a borrowing and lending arrangement, and if the corporate fails to pay back the money to the mutual fund, there is a default. So in debt funds we talk about defaults, in equity we don't talk about defaults.
So Kayezad, what happens if there is a default?
So as I said that the borrowing and the lending arrangement between the debt fund and the corporate, that is actually rated by a credit rating agencies. So what happens is that when there is a default, meaning to say that the company cannot repay the interest, cannot pay the interest on time to the lender, that is a mutual fund, or worst, it cannot repay the principal back in time to the debt fund. So in this particular case, what happens is that the valuation of the debt security falls, the credit rating falls, and if the credit rating falls, the price of the debt security automatically also falls, because obviously if there is a default, then the market worthiness or the credit worthiness of the borrower also gets impacted. So in a default, in a debt fund, the value of the underlying security also falls. If the value falls, then obviously your net asset value of the mutual fund also falls, which means that you as an investor suffers a loss.
Kayezad, can you also explain side pocketing in a bit more detail?
So what happens is that, you mentioned the term side pocketing. That's an interesting term which we have been reading a lot about of late. What happens is that, when there is a default in a debt fund, there are various ways of tackling that default. Either, as I said, the entire NAV of a mutual fund, debt fund falls, okay, or the fund house basically segregates the bad asset from the good assets. So the process of segregating the bad assets from the good assets is called side pocketing. What it means is that, suppose if you are an investor in a debt fund, if there is a default in your debt fund NAV falls, right? So what a debt fund manager does is that it takes out that bad asset, it segregates your unit as a whole, which was a whole, into two parts. One is the bad unit and the other one is a good unit. The bad unit, you can't do anything about it. Your debt fund will hold that unit till, and you have to hold that unit till your debt fund recovers the money from from the underlying corporate. The good part of the unit is yours for you to sell if you want to sell, if you want to buy more, you can buy more. If there are new investors outside who want to invest in this debt fund, they can buy the good units and not the bad units. So side pocketing is a very clean and efficient way to deal with defaults because it takes out the infected portion from your entire portfolio and keeps it aside. It quarantines your the infected portfolio. That's what side pocketing is.
And well, not all funds have actually done side pocketing, right? So why have they really avoided it?
So in the recent last 6-7 months, actually, you're right that there have been quite a few cases of default and delays in interest payments, but not everyone has done side pocketing so far. Only Tata Mutual Fund has done side pocketing, as we know. Now the thing is that side pocketing obviously is a mechanism that SEBI has allowed mutual funds to make use of, right, in case of a default. But there are a lot of onerous conditions that SEBI has put on fund houses, and rightly so, if you ask us, because side pocketing should not be misused. It should not encourage mutual funds to take undue amount of risks and to risk defaults as they go along, just because there is a side pocket mechanism available. So what happens is that SEBI has said that, okay, if you want to do side pocketing, you have to take investors' permission. It is like a fundamental attribute, right? So if you want to incorporate the provision to be able to do side pocketing, you have to ask investors permission first. And if you want to ask investors permission, you have to give them a chance to leave the fund for about 30 days or so without paying any exit loan. So that's a big onerous condition. Fund houses don't actually want investors to go away, especially in these uncertain times. Another condition which is there for side pocketing is that if the fund house actually does side pocketing, the bonus that is to be paid to the fund managers would be impounded, and it would be taken back. So there are a lot of these onerous conditions, plus there are a lot of disclosures and disclosures to be made to the regulators, disclosures to be made to the investors when you do side pocketing. So not many funds have actually applied for side pocketing. And Sakshi, let me tell you that you can't just straight away do side pocketing. You have to first apply to be able to do side pocketing through your offer documents. When I said that you need to give the exit free option to investors, after that, whenever there is a default option, then you can or cannot, you may or may not want to go for side pocketing. But you have to at least put that condition in your offer document.
And Kayezad, what have these other fund houses done instead of side pocketing?
So what other fund houses have chosen to do is that they've just chosen to mark down the value of the security. As I said, when there is a default, there is a credit rating downgrade. When there is a credit rating downgrade, the NAV of a debt fund also goes down. When it goes down, in this particular case, many fund houses have chosen to let their NAVs go down and to prevent opportunistic investors to come inside the debt fund at lower prices to gain advantage of a future recovery. These fund houses have they've stopped subscriptions. They've told the investors, boss, you can't come into these funds. We are stopping the subscriptions temporarily till we recover the money. So that is what some fund houses have done. There are other fund houses. There's one fund house in particular which has actually increased the exit load for new investors who have come after the default, so as to discourage opportunistic investing.
And lastly, Kayezad, what do you think is a better option, side pocketing or the other route of just writing down the values and stopping the inflows?
Sakshi, side pocketing obviously is a better option because it's a cleaner option. You are recognizing the disinfected portion of your portfolio, you're keeping it aside, you're quarantining it, and life goes on for the other unit, the good units. Like existing investors can sell, they can buy more, new investors can come and buy more. It's a very transparent way of dealing with the default, and no new investor can come into the fund to just take the opportunity of a potential recovery that could lead to an NAV surge in the later, because the bad asset is quarantined and the benefits of that recovery as and when it happens is due only to the existing investors. It doesn't go, the spoils doesn't go to the new investors. So obviously side pocketing is a much cleaner way to deal with bad assets in a debt fund.
Well, thanks a lot, Kayezad, for sharing with us all those details. Now, moving on, the Union Cabinet has approved the Aadhaar Amendment Bill 2019. Now, these amendments proposed are the same as those contained in the ordinance promulgated by President Ramnath Kovind on March 2nd, 2019. Watch this insight to know more. Union Cabinet has approved amendments in the Aadhaar laws and the bill will be introduced in Parliament's current session. The amendments proposed are the same as those contained in the ordinance promulgated by President on 2nd of March 2019 and are as per the directions of the Supreme Court and recommendations of Justice B. N. Sri Krishna Committee. The proposed amendments would allow the use of Aadhaar number for authentication on voluntary basis as acceptable KYC document for opening bank accounts. These amendments come after the Supreme Court barred private companies from using Aadhaar data in an order last year. The Supreme Court struck down the Section 57 of the Aadhaar Act 2016 that allowed the use of the unique ID for establishing the identity of an individual for any purpose, whether by the government or private corporate entities. Fintech startups selling loans, mutual funds and insurance as also payment banks which used Aadhaar authentication have been affected by the Supreme Court order. As paper-based KYC systems are expensive and time-consuming, both from customers and the institution's point of view. In the physical paper KYC model, credit facilitation may take more than 3 days, against the 10 to 15 minutes for the online model. According to industry experts, an e-KYC verification and onboarding costs 15 rupees per person for fintech companies and banks compared to 100 rupees per person in physical verification. The amendments proposed in the bill, once passed by the Parliament, will allow fintech and the telecom companies to use Aadhaar as KYC for customer verification if customers are willing to disclose details on a voluntary basis. Well, to discuss in detail about the Aadhaar Amendment Bill, I have with me Gaurav Choudhury, Deputy Executive Editor of Moneycontrol. Thanks a lot, Gaurav, for joining in. Now, this bill has been approved by the Cabinet. It will be up in this parliamentary session as well. So, what are the key features, if you could just tell all our viewers now?
So, we have to keep in mind that this bill is actually was also introduced by the outgoing government in just before the demitted office. And because the Lok Sabha got dissolved, it could not be passed. This bill has been necessitated by the Supreme Court order in October 2018 when it struck down Section 57 of the Aadhaar Act, which essentially meant that private companies cannot use Aadhaar as for their business purposes, for commercial purposes. So this essentially meant that companies like telecom companies or fintech companies or banks or financial services companies cannot use their customers' Aadhaar for carrying out know your customer the processes as well as other requirements. So that ruling, that Supreme Court ruling had put them in a quandary, because the Supreme Court ruling had struck down Section 57 of the Aadhaar Act and essentially meant that Aadhaar can be used only by the government departments and for purposes of welfare delivery processes. But fintech companies and telecom companies and similar companies have been lobbying with the government to find a way out, because moving back to offline physical verification for carrying out KYC, for instance, was extremely time consuming and also costly. So these amendments are essentially aimed at facilitating a similar kind of a process where private companies can actually use customers' Aadhaar if the customers voluntarily agree to part with those details.
Absolutely. So upon the passage of this bill, will it be now up to the people to decide whether they want to voluntarily give Aadhaar as a document proof or not, or will it be still a grey area which all the companies can?
So it entirely depends on the customer. If the customer agrees that she or he wants to disclose the Aadhaar details on a voluntary basis, then their authentication and identification, authentication, and all other processes related to the KYC system by banks and telecom companies, for instance, can be carried out as was before the Supreme Court ruling. But if customers don't want to disclose their Aadhaar details, then companies will have to go back to physical verification. So it's entirely up to the customer. The companies can only give them an option that if the customer wants to disclose details entirely on a Aadhaar details entirely on a voluntary basis, then their KYC will be carried through the Aadhaar process. Otherwise, it has to go back to physical verification.
Right. So if people actually give this as a voluntary data or a document proof of KYC, will it still carry the risk of being misused, the data information?
No, I don't think so. I don't think Aadhaar data can be misused, and Nandan Nilekani, who is the founder, the father of Aadhaar,
Sure,
as he is often referred to, has time and again said that that it cannot be misused unless it's because these are stored in central servers, which are extremely safe and secure. But that fear of misuse is always there.
Yeah.
And that is the reason Supreme Court gave a ruling of that nature. And the government has tried to, through these amendments, has tried to find out a way that those who do not fear that their data will be misused can voluntarily agree to part with those details, because that's going to hasten the process. It makes the system, the KYC system and other financial services delivery systems far more efficient. And so the government has placed the onus entirely on the customers and individuals to whether they agree to disclose those details or they don't. If they fear that there is a possible risk of a misuse, then they can clearly agree not to disclose.
Right. And is this a big relief also for the fintech companies which have been not allowed to do the eKYC so far?
Clearly, because fintech companies and telecom companies that we have been speaking to have always pointed out that going back to a physical verification process is extremely time consuming and is also costly. For instance, eKYC, as it is called, electronic KYC through biometric authentication based on Aadhaar, takes just a few minutes.
Yeah.
Whereas if you go back to online physical verification, it can sometimes take up to a week. More than that, it's also costly for companies. So an eKYC, Aadhaar-based eKYC verification system, onboarding a new customer would cost them about 15 rupees on an average for fintech companies, whereas for physical, the same would cost about 100 rupees in a physical verification.
Right.
So clearly there are cost advantages, and there are also time advantages so far as eKYC based on Aadhaar is concerned.
Right. Now, Gaurav, in our previous discussions on this show as well around Aadhaar, we have talked about various mechanisms around Aadhaar. We've spoken about the QR code mechanism. We've also spoken about the offline Aadhaar or the Aadhaar linkage with driving licenses, which was being mulled by the government. So where does all of that find place in this bill?
So QR code based verification as well as offline Aadhaar were one of the options that the government or the fintech companies had recommended pending proposed amendments in these Aadhaar laws. If the Aadhaar laws were amended and it was voluntarily and purely on a voluntary basis, then and if those did not come through, then QR code based or an offline Aadhaar based system probably would have been the second best option. But this is the best option for fintech and telecom companies so far as customer acquisition and verification is concerned. So far as linking of Aadhaar to driving license are concerned, driving license, many states have already done that.
Yeah.
And we are still awaiting. We expect the Motor Vehicles Amendment Bill to be passed in Parliament this day. It has been pending in the Rajya Sabha for almost 2 years now, and we expect that bill to be passed in the coming session, which effectively begins from the 20th of June. So by the time this session ends, the monsoon come, the budget session ends of the new government, we expect the Motor Vehicles Amendment Bill to be passed.
Okay.
And once that is passed, probably linking of Aadhaar to driving licenses across all states will become a uniform necessity or could become a uniform practice. And again, I think that, and since this is a government thing, I don't think it's a government department driven process. I don't think individuals will be resistant to sharing the Aadhaar details, because there will be less fear of misuse, because this is a government department driven process. But linking of Aadhaar to driving licenses clearly is something, an idea whose time is overdue.
Is there any mention about the penalties in case there is a misuse?
That those penalties are well defined in the case of the Supreme Court order itself, and also in the existing Aadhaar law. So the penalty, if anybody is found to be misusing private Aadhaar data, I mean, one, there is a chance of a misuse, and the other is misusing that data.
Sure.
Both are criminal offenses. So those are very well defined in the existing laws.
Okay, okay. And by when do we expect this bill to finally become law and come into effect, and how will it really benefit the end-use customer?
The bill will have to be tabled in Parliament, and then if it goes to the committees, the standing committees, it will take its own time. But by the end of this monsoon session, we expect the bill to be passed in Parliament and then notified.
Okay.
After which the rules are framed, and then it comes into law. So it's voted into law and becomes a law. So the new amendments will be brought into the laws, and it becomes effective after it's notified and the rules are framed. That is one. But so far as end use customers are concerned, clearly again, getting a bank, getting a telecom subscription, or getting a bank fintech account opened, or a loan account through a fintech company will become far more easier and far more time efficient, because you can probably get loans as was before the Supreme Court ruling in a few hours, compared to a physical verification which can take up to a week.
Right. Thanks a lot then, Gaurav, for sharing all that insight with us. Well, the bill definitely gives us hope of a more robust mechanism to serve the public interest as well as restrain the misuse of Aadhaar. All eyes are now on the fast passage of the bill in the Parliament. Moving on to markets now, Santosh Nair, editor of Moneycontrol, joins in with all the action in the stock markets and cues for the week ahead. Thanks a lot, Santosh, for joining in. Now, first up, could you sum up the action on Dalal Street this week? How did the markets really pan out?
Well, Sakshi, it was quite a volatile week. A lot of action on either sides. Market now seems to have settled into a narrow trading range. The initial euphoria over BJP's landslide win appears to have cooled down for the time being, and once again, investors are now focusing on the more fundamental aspects of the market. Having said that, the big concern obviously is that there is no significant improvement as far as the earnings are concerned, and you're not having any other positive triggers, in fact, to look forward to. In fact, wherever you look, the situation appears to be a bit challenging, be it fund flows, both from the foreign and domestic institution side, be it the economy, which is still in the midst of a slowdown, and then you have other factors like crude oil prices also, which have been fairly volatile. So there is no compelling reason for investors to buy at higher levels. So you're seeing whenever the market does tend to break out on the higher side, you're seeing more of selling, not enough of buying interest that is coming in, because of which again prices are drifting lower. Also, there are quite a few other factors at play. So some of the stocks in FNO, SEBI has mandated compulsory delivery for them. So those stocks saw some kind of a sell-off. Again, much of the buying is being restricted to the top frontline stocks there. So while you're not seeing much of damage to the main indices, if you look at the mid cap, at the broader market, which comprises of mid caps and small caps, you're seeing that pretty much things haven't changed much. There is severe pressure there, because of which you're not seeing any major inflows coming into domestic mutual funds. Clearly, there's been a lot of underperformance there. So local fund flows have been a little sedate. You're seeing money coming into SIPs, but not big money coming into as one-off.
Well, Santosh, central banks and their actions have been in focus this week as well. How did the markets react to statements from the ECB as well as from the US Fed?
So clearly, the Fed's hint that it was open to a rate cut did fire a rally in stocks across the globe. So the hope is that in case the Fed does cut rates at some point, you could see more money flowing into emerging market equities. That's why you saw shares rally quite a bit on Wednesday. But overall, still the mood is a bit cautious. So you may see some spikes here and there, but the mood is cautious. So it's unlikely that the market could break out of this trading range.
All right, Santosh, and what are the big cues to watch out for in the coming week then?
So next week, the trigger obviously will be the rollover of equity derivatives position. So that could keep the market a bit volatile. Beyond that, obviously, the focus will be on the budget. That is the next major trigger for the market.
Thank you, Santosh, for sharing with us all those details. And with that, it's also a wrap here on the Moneycontrol show. But you can catch up on all the news from the world of business and finance on our digital platform, moneycontrol.com. Many thanks for tuning in.